Hello, we're here today to talk about the outlook for the U.S. economy in 2018. For that, we welcome Michael Feroli. He's U.S. chief economist for J.P. Morgan. Jay Berry, also welcome. He is the head of strategy for U.S. Government bonds. Welcome both. So let's start with Mike. Mike, where are we standing, and can we expect this recovery or this expansion that has lasted already for 9 years in 2018?
Yeah. So for 2018, we think it's going to be another pretty good year. We're looking for growth around 2%, which is pretty similar to the outcome we saw in 2017. So that should push the unemployment rate below 4%, and we think it should get inflation back up toward closer to 2%.
Inflation up means Federal Reserve also moving interest rates up. What are your projections?
Yeah, so the Federal Reserve in December, they projected that they'd be increasing rates 3 times this year. We actually think they're going to hike 4 times in 2018. We think in part because the unemployment rate continues to fall faster than they've been forecasting. And we do think that as they go through the year, they probably will be a little bit uncomfortable with keeping rates as low as they are, given how tight the labor market is. And we do think inflation, as I said, firms closer to their target of 2%.
Now let's move to the markets. Is the Treasury market pricing in those interest rate increases that we are forecasting at J.P. Morgan?
Not exactly. Right now, the market's pricing in about 2 rate hikes for 2018, so about half of our forecast and 2/3 of the Fed's own forecast for the coming year. But really, that's not unusual, because if we look back toward historical precedent, it's been very unusual to price the Fed's full forecast in. And in fact, if we go back to the last tightening cycle in 2004 to 2006, in the second half of that cycle, we priced in about 60% on average of what the Fed would ultimately deliver over the next year. So we're kind of pretty fairly priced at the front end right now, we'd argue.
How about Treasury yields? What are your expectations for 2018?
Sure. Well, given Mike's forecast that we're projecting 4 hikes next year, we think yields across the curve can rise, but we do think that the yield curve will flatten. So we think the 2s-10s curve should flatten to 15 basis points over the course of this year.
What can mess up those projections?
Well, I think on the downside, clearly the last year, in 2017, has been one of synchronized global expansion. If for some reason we're wrong about growth and the Fed delivers less tightening, that would result in lower yields and a steeper curve than we project. But on the flip side, we're clearly expecting Europe to be the engine of growth this year in 2018. And if that's the case and it forces the ECB to act more quickly to taper its asset purchase program, that could have an impact on Treasury yields in a more bearish fashion.
We have the Federal Reserve. We're going to have a new chair, Chair Powell, next year. What can we expect? What are the implications of this change?
So everything we've seen from Chair Powell, or incoming Chair Powell, is that he's been a governor for 5 years. He has never dissented. His public speeches are very much in line with what Bernanke and Yellen were advocating. So we don't look for massive transformation in terms of the way policy is set. He's a company man, so to speak. But we do have to keep in mind that there still are several vacancies on the board, at least 3 when Yellen steps down in February. So, we don't want to say it's complete continuity because we don't know the identity of these incoming governors. But what we see so far suggests a fair amount of continuity.
So we're going to wrap up. I mean, if you're going to define 2018, you seem to be optimistic, but a little bit cautious regarding 2019. How would you define it? I mean,
I would say, look, for what we can have any visibility on, which really is 2018, things look pretty good. And then we'll address 2019 when we get there.
How about you, Jay?
Yeah, I think in our minds, higher yields and a flatter curve. So in one word, flatter.
Okay, well, thank you very much both for your time. Thank you for tuning in. And if you want more insights, you can follow us, JP Morgan, in social media or check our website.